Welcome to Fundamentals, a platform to understand your fund tenets. In today's episode, we discuss UTI Flexicap Fund, a fund with a vintage of over 2 decades, annualized returns since inception of around 12.6%. This fund is one of the largest flexicap funds in the industry. It is being managed by Mr. Ajay Tyagi, who is the head of equities at UTI Mutual Fund. He has been responsible for managing this fund since January 2016. Thank you, sir, for joining in, and it's a total pleasure to have you with us.
Thanks, Megha, for having me on this show.
So you have been known in the industry for your strict investment style and philosophy. Could you help us understand the philosophy with respect to UTI Flexicap Fund?
Sure. So, the philosophy is very, very basic, I would say. It starts from the first principles of owning businesses that create economic value. You just have to take a step back to realize that how does wealth get created? I mean, to my mind, in my limited experience over the last 22 years, wealth creation was, is, and would never be in the future a function of trying to catch market trends, trying to figure out what will do well in the next 6 to 12 months, trying to figure out the direction of interest rates, and therefore, taking calls or rotate among sectors. At a very basic and rudimentary level, wealth creation is about identifying great businesses that create strong economic value, becoming a shareholder or a participant in these businesses, and then very, very patiently enjoying the ride. And when I say being patient, I think 3 to 5 years is the bare minimum time frame that investors should give to themselves. I would ideally bat for at least a 10-year time frame. So that's the most fundamental understanding which investors ought to have. That's what the investment gurus over the last many, many decades have proven, both in India and outside of India. And I think our philosophy is basically just, trying to not reinvent the wheel, but trying to actually play out this core phenomena as part of our basic strategy.
Right, sir. So we are not advocates of T20, but of test matches. Your stock selection processes have been quite spoken about. So can you give us an example of any of the underlying stocks? What was the thought process behind owning that particular stock that you do?
Sure. I think I'll try and connect this back to the response to the first question that you had. So let me talk about, one of our holdings, which is Avenue Supermart. And let me tell you how we think about it, why we are so convinced and bullish about it, and why have we been holding on to it despite the volatility that we have seen in this stock over the last 6 to 12 months. So, at a very high level, we need to understand that retail industry, especially the food and grocery retailing, is the biggest industry that you would see in any economy, because it is essentially to do with the everyday essential items you and I cannot live without. These are those items which we would need whether the economy goes through a recession or it goes through, let's say, a huge upswing in activity. So for a $3 trillion economy, which India is today, food and grocery retailing is $500 billion. Now, if you look at this $500 billion, more than 90% of it is what we call as mom and pop retail. So you have these corner shops in certain parts of India, they're known as Kirana stores. You have these small shops dotting the country from where we pick up our essentials, our toothpaste, our soaps, our shampoos, and so on. Now, if you look at how the West has progressed over the last 40, 50 years, you would have noticed that there have been organized retailers which have continued to grow and which have actually led to a huge amount of consolidation in the food and grocery retailing. And these organized players in the Western world, in let's say US, command 90% of the overall market. It's exactly the reverse in India. In India, all of these organized players put together, whether it's Reliance Retail, whether it is DMart, whether it is Flipkart, whether it is Big Basket. So all of these guys put together are not even 10%. They're maybe about 8% or so. DMart in particular is just 1.5% of this entire opportunity of 500 billion. Now, we've seen the business model pan out over the last 2 decades. It's been listed now for almost 5 years. We've seen how resilient the business is. We've seen how it's been able to withstand competition, both in terms of offline retail and the huge discounting-led model of online retail. And yet this company continues to chug along with strong growth numbers and very, very strong margins. Perhaps the only guy who's so profitable in this industry, which is hyper competitive. Now, that gives you a very strong insight into how well this business is managed. So, a well-managed business which has been able to withstand hyper competition in the last 5 years, opportunity which is huge. Don't forget, this $500 billion market itself is growing at about 7-8%. And within this, organized retailers have been growing at 20%, perhaps could continue growing at such strong numbers into the future as well. So that actually is the entire reason for us to be excited on a business like DMart, which grows strongly, which has the moats to defend its margins, which generates strong return on capital employed. And if as patient shareholders, we continue to remain invested in this business, we will be able to, take the ride on the wealth creation that would unfold in the coming decades. And I would say beyond a decade as well. Yeah.
Right, sir. So the scope of business is very well explained here. So my next question to you is, how should an investor assess this fund in different market cycles? If you could help us understand the risk return of this fund in different cycles. And I think you alluded to the point that you're looking at an investor for 10 years. If you could throw some light on this.
Sure. Megha, I'll take the second part of your question first. Let's talk about risk. If you have a very close look at the fund, you would realize that we are essentially buying very strong businesses. For us, what is most important in portfolio construction and stock selection is the quality of the business. It's never the valuation. We're never worried about valuations. Of course, it's a point that we always register, but it comes much later. The starting point is always the quality of the franchise, the fact that it generates strong cash flows. It is not dependent on external sources of funding. It has a strong balance sheet with low to no debt. And because of all of these attributes, the risk profile of our portfolio is always lower compared to the market. If you look at this portfolio over the last, I would say, 7 years now, or 6 years now, you would realize that the beta of the fund, which is one of the measures of capturing the risk, has always been lower than 1. I would say somewhere between 0.8 to 0.85. That itself tells you that the risk profile of the fund is low. And the fact that we've created alpha in the last 3, 5, 7 years tells you that we've created this alpha while actually taking significantly lower risks than the market. So that's on your risk return framework. Now, market cycles, you see, it's very, very important for this point to be appreciated in terms of how we construct the portfolio and whether we have any regard to the underlying benchmark. You see, ours is a strategy in which we are, like I mentioned, picking up the best quality businesses which will create wealth in the long run. We're not worried about what will do well, which stocks will do well, and which stocks will not do well in the near term. Therefore, our portfolio is very different from the underlying benchmark. The active share, which is basically nothing but a description of how different you are from the benchmark, for us is close to 70%, between 65 to 70%. So that tells you how different we are from the benchmark. And obviously, if we are different from the benchmark, there will be times when we hugely outperform the benchmark. There will equally be times when we hugely underperform the benchmark because the similarity is very, very little. But if the stock selection has been right, then like in the past, we remain fairly convinced that over longer periods of time, we will generate alpha, we will create wealth for our investors, regardless of during shorter time periods, 6 months, 12 months, sometimes even more than 12 months, we could be underperforming. I think so. This is a very important facet for all our investors to appreciate, that how are we looking at portfolio construction? Are we really worried about, we underperforming the benchmark in the next 3, 6, 9 months? And, what is really leading to our conviction in terms of long-term alpha creation? Yeah.
Right, sir. I think this fund has also generated alpha since inception as well. So, with the recent SEBI recategorization, UTI Equity Fund erstwhile has now been UTI Flexicap Fund. So now you have, you can run this fund agnostic of the market capitalization. So what helps you decide the relative allocation to each of these categories?
Yeah, I think that's a great question, Megha. Thanks for asking us this question. So, we are bottom up in our approach. We don't take top down views, like I mentioned. We're not bothered about where the interest rates are headed, inflation is headed, exchange rate is, geopolitics, whether Taiwan would be bombed by China, and so on. We're more interested in the microeconomics of businesses. We're more interested in how many cars would Maruti sell over the next 5 years. What's the car penetration for Maruti? And that's why we call ourselves truly bottom up. And therefore, we are agnostic to sectors. We never take top-down sectoral calls. Equally, when it comes to playing large, mid, and small, we are agnostic here as well. To us, what matters is that the best businesses that this country has to offer should be part of our portfolio. If in the hunt towards getting the next best business in our portfolio leads us to discovering a large cap, so be it. If this hunt leads us towards a small cap, again, so be it. So we are agnostic, and you're absolutely right. SEBI provides us this elbow room to construct this portfolio any which way that we wish to. We can have 10% small caps in the portfolio, which is the case today. We can even have 15% small caps in the portfolio if, let's say, the best ideas are coming in from that bucket. So we give ourselves this entire latitude to actually construct our portfolio, and our only condition is that we'll remain sector agnostic, market cap agnostic. We will remain bottom up. The best businesses with the best growth outcomes along with the best value creation drivers will come into our portfolio. Yeah.
My next question to you is on the size of the fund. This fund is over 25,000 crores as far as AUM is concerned. So is size an advantage or a disadvantage?
Again, a very excellent question, because there are many people who ask us this question. Let me make a few points here. Point number one, Megha, you've been watching this fund for the last more than 5 years. You and Harsh have been one of the early ones who discovered this fund. If you recollect, we were about 6 to 7,000 crores, maybe 5 years back. We are 26,000 crores as we talk. So we've gone up almost 4x. You would appreciate that there is nothing that has changed in the way we have managed this fund. We used to be about 50 to 55 stocks back then. So are we today. You would realize that we haven't changed the portfolio in terms of our churn ratio. When the fund was much smaller, we would still have a portfolio turnover ratio. Some people call it the churn ratio, between 10 to 15%. It is no different from what it is today. Essentially because on a first principle basis, like I said, as a response to your first question, we want to really own great businesses, own them patiently, and ride on them for a fairly long period of time. I ideally hope and wish that a majority of the portfolio of companies that we have outlives me. So that's basically, the core ethos. Therefore, when the fund moved from 7,000 to 26 and hopefully to 50,000 in the next few years, this fundamental attribute is not going to change. We are not trying to move the fund around from one direction to the other, from large to mid, or from pharma to, let's say, IT, or from IT to banking, just because the next 6 months is basically, favorable for a particular sector and unfavorable for something else. We are really being patient shareholders into great businesses, and therefore that gives us a huge amount of ability to manage large-sized corpus. Point number two, it goes back to Warren Buffett saying, and I consider him to be a person from whom I have learned pretty much everything in the way I manage my fund. And I remember reading one of his quotes in which he said, assume that you have been given only 25 bullets, which once fired cannot be reused, and assume that you can take only these 25 shots in your lifetime. And if that's the assumption, be very, very careful before you use these bullets. And the analogy here is, don't try and buy anything and everything which looks to be good for the next 6 months, but try and buy things which look to be good over the next 5 to 10 years. With that philosophy in mind, we anyway have very, very little activity in our fund. We take quarters and quarters, if not years, to get excited about a business. And once we have it in, we really don't feel the urge to move out of it, churn it, increase exposure, reduce exposure, just because 2 or 3 quarters have been bad. That is a second point, which is very important. And since you asked advantage or disadvantage, many people don't realize this. Managing a large size fund for a person like us is an advantage, because it prevents you from investing into so many things which I consider to be purely noise rather than value creative. We dismiss so many of these ideas because we know that, look, we're not going to hold them for a long period of time. And our size basically prohibits us from being very active. And that is a big boon because we are concentrating on the best ideas. Yeah.
Right. So I think not just Harsh and me, but any of the people in the fraternity who would have interacted with you would, really be very appreciative of your philosophies that have been consistent over the years. Uh, so we have seen a lot of fund houses and even few funds, which have had accidents. But if we analyze your fund, we have not witnessed any of these. Now, corporate governance is a very qualitative issue. So how do you ensure that, you do a just job at it?
You're forcing me to now speak in the language of aviation, which talk about accidents and incidents. So you're right, we may not have entered into accidents, but let me be honest, we've had many incidents. And I think we will continue to have incidents in the future as well, because this is a business where you will make mistakes, no matter how good you are in terms of understanding the nuances of a business. But all of us, after all, are fallible, and therefore we will commit mistakes, which we would call as incidents. Now, your question is valid. How do we reduce the incidents, and how do we really, really minimize and make the accidents to be very close to zero? It again goes down to the fact: are you really investing into a great franchise which you understand, which is being managed by people who really are trustworthy, which is being managed by people who are passionate about running that business rather than actually, driven by certain other parameters? It could be, financial benefits. It could be, their respective bonuses and so on. And if you try and spend a lot of time around that before getting excited about a business, I think you reduce significantly the chances of accidents. Equally, yes, everybody is looking at the same balance sheet, the same cash flow statements, but it is also about how deep you are going into those balance sheets and cash flow statements, and you are being really honest to yourself. One of the mistakes that all of us make is we get excited about a story. Once we get excited about a story, we then try to actually work backwards and therefore, justify a lot of things, even if they are actually telling you or showing you red flags or amber flags. We first want to, before getting carried away by the story, we want to look at the history of the company, the financials of the company, how they've been behaving towards minority shareholders, and then go to the next step of how exciting the story is. So I think this has helped us minimize incidents, hopefully reduce accidents to as close to zero as possible. And I think if we replicate this into the future, we should be able to do the same.
Right, sir. Just taking it a little forward, if you could just highlight for us a few calls which have gone right and some not as planned.
Sure. No, so there have been a host of them. Let me start with the bad news first. There has been a host of them which haven't gone well for us. I remember getting excited about RBL Bank. And the story behind RBL was the fact that it's partnered with Bajaj Finance, and it would be like the the American Express Bank in the US, which over the last 30-40 years has grown its franchise predominantly on credit cards as the key segment for Advance's growth. And I thought that that's really the American Express of India. But I think I should have spent more time in looking at their historical track record. I should have spent more time on their existing corporate book, because the blow up happened in the corporate book rather than on the credit card side. That was a lesson well learned, that you have to give yourself time. You have to be patient. You have to see the history for a fairly long period of time before getting excited. Number two, let me switch the sector and talk to you about the healthcare sector. Let me talk about Lupin. Something which we eventually sold out sometime in 2019 or maybe early 2020. And the reason was that, so first of all, we were excited about this business because of their very strong execution in India, which they still do, but equally a very strong execution in the US market. I'm talking about the time period of 2013, 14, 15 here. And we were really excited about how they were showing growth there, how they were getting into new molecules on the US generic side, and therefore growing their business profitably. What I did not appreciate is the fact that US generics essentially is a commoditized market where the big differentiation is the price at which you sell rather than the brand that you carry. And that, eventually did have to play out. And all, US generic companies did face a lot of pressure, including Lupin, and Lupin started to face pressures outside of US as well. So I think the big lesson there was that I did not understand the structure of the US generics industry rather than being very, very specific about Lupin. And I think that was again a lesson learned. On the positive side, of course, there have been many things which have played out well. Bajaj Finance, our top holding, has played out well. Again, it was a stock which was never cheap. When we bought it, it was not cheap at all. But I think we were really fascinated with their last 5-6 years of track record. The fact that not only did they show strong growth, but strong growth along with strong ROAs, and they were able to withstand the pressures on the asset quality, which post our buying, they've been able to demonstrate in 2016 during demonetization, 2018 during the NBFC crisis, and 2020 during the pandemic. Do appreciate the fact they have a very strong unsecured book, and yet they've been able to have very strong asset quality. Equally, in the technology side, Info Edge may not have done well in the last 6 months, but we've been holding it on for 10 years now. It's been in this fund since 2016 and has been a great wealth creator. I think it's still one of the best managed internet companies in India. Very, very passionate promoters, extremely driven by the core fundamentals about doing something very, very different in India by backing business, by of course having their core business of recruitment and real estate classifieds, equally backing businesses like Zomato, Policy Bazaar, and a dozen more which are much smaller today but part of their portfolio. So yeah, I mean, we've had our shares of hits and misses, but so long as you're able to back your hits and be patient with them, I think this business certainly, this core strategy and philosophy certainly rewards you in the long run.
Very true. Sir, my last question to you is that you are the face of this fund, but I'm sure there would be an equity investment team at UTI Mutual Fund who would, kind of be taking owners of the research that goes into the stock selection process as well. So if you could help us understand them a little bit.
Great question, Megha. This is a tribute to all of our research analysts and my other colleagues who work alongside. And quite frankly, you've nudged me to take an example from the Bollywood. While Lata Mangeshkar and Mohammed Rafi, two of my favorite singers, would have had huge amount of accolades come their way, but the unsung heroes were basically the lyricists, the music directors, the technicians, the orchestra as part of the entire team of music directors. And I think so is the case with us. While we are the front face, while some of my other colleagues could be managing the large cap strategy or the value strategy very well, and therefore we get all the accolades, awards, and the pat on the back. But the real strength of this institution are really the analysts who are day in and day out, following the process, doing all of the things that I just explained to you, assiduously looking at the balance sheets, fishing out data, meeting managements, going to the plants and figuring out whether really the plants are world-class or not. And therefore, I would say that the real credit has to go to the entire research team who are the bedrock. And because that we are so process-driven, I think our outcomes really are a function of the efforts that we make in our core research. So yeah, thanks for asking this question, and in a way, paying the tribute back to our entire investment team.
Right. Kudos to you and the entire team. With this, we come to the end of this discussion. As always, it has been a pleasure with a lot of anecdotes, examples, and analogies that we carry forward. But we definitely understand that the bottom-up stock selection is the key principle behind managing this fund. Thank you, sir, for giving us your time, and we hope to get in touch with you soon. Thank you.
Thanks, Megha. Thanks to you, to Harsh, and your entire team for giving us this opportunity. Always a pleasure, taking our questions. Thank you.